Okay, folks, part two. So here's the deal. Risk and reward are tied together. You're not going to get a big return unless you take risks. It's just the way all investment markets work, irrespective of what country you're in, unless the market's totally rigged. And even then, if you're a common citizen, you're going to take a bunch of risk and you're going to get whatever return they're going to give you. So risk and return are tied together. So all the markets are based on taking risk, whether it's the bond market, stock market, art market, precious metals, currencies, equities, doesn't matter. It's all based on taking risk. The thing about risk is that people get uncomfortable with risk. They look to either diversify the risk or mitigate the risk, meaning lowering it, right? Or if possible, to get rid of it altogether. Now, markets are not perfect, but market theory says that markets tend to move towards perfection, meaning that if you buy something that has more return than the risk you're taking says it should have, the market will eventually change that proportion back to where the investment is the proper return for the amount of risk you're taking. All right? That's called alpha, by the way. And I don't want to get too deep into portfolio management theory, but there are a lot of books out there about creating alpha, finding alpha, right? Trading for alpha. That's all about finding underpriced investments. And therefore, if you find an investment that's underpriced, theoretically, you're going to get a higher return than the risk you're taking on that investment says you should get. That's the whole concept of investing right there, right? If you go to work for a hedge fund, you go to work for a big money manager, doesn't matter, you're always seeking alpha. You're basically seeking underpriced investments, whether it's real estate or art or precious metals or energy or currencies or equities or bonds, doesn't matter, right? Everyone's looking for alpha. So what we're going to talk about this semester is better understanding of risk, better understanding of the various investment markets, and better understanding of how those markets function. So now that we've kind of started down that road, let's look at equities, right? So in the beginning, before there was really an equity market of any sort, the whole investment community was about lending. And so if you go back into the 15th century to Italy, where really banking started, what you'll see is that those banks pretty much lent money. They didn't invest money. Over time, actually, the European banks became leaders in investing money as well as lending money. But back in the 15th century, it starts as a loan. That concept of lending makes its way through Europe all the way to the New World, to America, by the 17th century. And so by the 17th century, we have a business plan. And the business plan is if you're an explorer, you go raise a bunch of money, they loan you the money, you pay the money back when you get back, and how you pay the money back is by bringing back a whole bunch of commodities, things that people want over in Europe, like animal skins, because there's not enough fur-bearing animals in Europe. So they want animal skins. They want certain fruits and vegetables that don't grow in Europe or don't grow well in Europe. So you bring that stuff back, you sell it, you pay back the loans, and whatever's left, you pay bonuses to your crew, bonuses to yourself, and some bonus money to your lender. All of a sudden the lenders said, well, hold on, I'm only making 8% on my money. What if I didn't lend you the money? What if I invested the money with you and I became your partner? And so the first investment vehicles were partnerships. And essentially what was a lender now becomes a partner. And therefore, when you get through the process of bringing the stuff back, selling it, paying off your creditors for things like maybe food where they gave you terms so you didn't pay them right away, there was a pile of money left. And you divided that pile of money up. So now I would come in as an investor and I'd give you all the money you needed for your voyage to go over to the New World. You'd come bring stuff back. You'd sell it, right? You'd pay the crew some bonus money. And what would be left would be a pile of money, and we would split it, or we would in some proportion, and I would make much more than 5 or 10% on my money. That process, which started with the explorers from Europe to the New World, created the whaling industry. And it created the whaling industry in Japan, it created the whaling industry in America. Once that happened, we had a game plan for how to do equity investments. So whether it was expanding your farm, building a canal, building a ship, building a railroad, or in the modern world, building a highway, or building an airplane, or building a company that makes computers, we now have a game plan. I'll come in as your equity partner. The problem with equities, or even debt, is that I'm kind of stuck in this investment for a period of time. What if I need liquidity before I had planned on getting it? What if I had planned on being your partner for a year, and 6 months into this investment, I need some money? I only have two choices. I can either borrow against that investment, or I can sell it, or I can sell part of it, right? So all of a sudden, people realized, I'm not stuck in this investment for the life of the investment. I actually can have interim liquidity. How do I get it? I go find someone who will either lend me against the investment or will buy part of my investment, if not all of it. So how do I find that person? Well, in America, by the mid-1700s, there became areas of large cities where people who had money and wanted to make investments would go hang out. And people who had investments or needed investment money would go hang out. And they would talk to each other. That place is called the Buttonwood Tree. So if you're ever in New York and you go downtown and you'll see Trinity Church, you'll notice, if you go to the back of the graveyard at Trinity Church, you'll notice that the land slopes down to the Hudson River. Okay? On the banks of the Hudson, literally right behind Trinity Church, was the Buttonwood Tree. And that became a place where people would go to find equity investors or lenders for their venture, or they would go to find investors or lenders who could help them liquefy their investment before the investment came due. Once that process started, it snowballed. And so the next step was that firms were established in New York City whose sole job was to match people who had money with people who needed the money. Whether it was loans, equity, didn't matter. And so the first brokers were actually investment bankers, right? They weren't like Merrill Lynch, where they wanted you to put your money on deposit and they would buy stuff for you or make recommendations. The first brokers were actually investment bankers. And what they would do is that now if you had a whaling venture you needed to get funded and you were up in Massachusetts, you'd come down to New York City, or you'd go to Boston, right? Or you'd go to Philadelphia, where all three had exchanges, and you would do the exchange, and you would go, who invests in whaling ventures around here? And the brokers would find you and go, look, I have a bunch of clients who want to invest in whaling ventures. Tell me about yourself. Tell me about what the plans are. Tell me what returns we're going to get. So we establish markets. From that, we establish what becomes the biggest equity market in the world, which is the New York Stock Exchange. So we go from the buttonwood tree, which starts really in the kind of the first part of the 18th century, around 1730, 1740. And it becomes the New York Stock Exchange by the early 1800s. Once that happens, and the Boston Stock Exchange, actually I think the Philadelphia Stock Exchange came first, if I remember correctly. I think the Philadelphia Stock Exchange came actually right before we declared independence from England, so like 1770. The Boston Stock Exchange was, I believe, second, and that was around 1780, 1785, and the New York Stock Exchange was third, but New York was a much bigger place than Philadelphia or Boston. So, no surprise, now we've got 3 major exchanges in New York, in America, and now you've got a place where if you're an investor, not only can you go and make an investment, but you can get interim liquidity. The only unfortunate part about the early stock markets was that they had no way to really hedge the risk. So your only way to lower your risk was to sell what you had. So you made an investment, a loan, or you bought equity. You became a partner in someone's investment scheme. You got worried about the risk, and so you sold it, right? You brought in new capital. After a while, foreign markets start up as well. I think some of them started about the same time. And today, right, we've got very mature equity markets in a lot of countries like Japan, like Germany, France, England, United States, right, and now China, as you know. And once we had these equity markets, investors started thinking about diversification to lower risk and other risk mitigation strategies. Okay? So once investors want more information because they have many choices, all right? So I can invest up in Boston, I can invest down in New York, I can invest with a whaling captain, I can invest with a sea captain who's going to go to the Orient and try and bring back spices and silk and all kinds of things, which obviously is China. I can I can put my money in a lot of different places. I now need information. Right? Where am I going to get the information? Well, I get it from the intermediary, the broker, the investment banker, and I start to get it from the exchange. And so the exchanges become formalized. And once that happens, exchanges become a place where capital is raised, a place where investments are resold, and a place where information is shared. That's what made these markets so important, and that's what made these markets as big as they are today.